Hi, I'm David Schenk. I'm an attorney and enrolled agent, enrolled to practice before the IRS, and I talk about tax issues, estate planning, and asset protection. Today, we're going to talk about the important question of can the IRS take your pension? The quick and unpleasant answer is yes. The IRS can garnish your pension payments, any payments that you were receiving from a 401k or a pension plan, just like they can garnish wages. And while your 401k or your IRA or your Kia account are usually protected from creditors, the IRS is an exception. They can even garnish your Social Security payments. There are limits. For example, the IRS can't take all of your pension payments if doing so would leave you unable to support yourself and your family. But generally speaking, just like with a wage garnishment, the IRS is first going to calculate how much you need for basic living expenses. And then they can only garnish the amount that's over that limit. However, I can assure you that you will not find the IRS's basic living expenses allowance to be generous. For example, if you are a single taxpayer with no dependents, the IRS says you can live on about $1,200 a month. And then they take everything above $1,200 a month. I don't know a lot of people who can live on $1,200 a month. With Social Security payments, the IRS is generally limited to only garnishing 15% of your Social Security check. Okay, so we know they can garnish payments from your retirement accounts and Social Security, but what about the accounts itself? Can they take, for example, your entire 401k or IRA? And the answer is yes again. The IRS has the authority to levy or seize the entirety of your retirement accounts. But levying the entire account is not going to be their first choice. Generally, they're going to do a three-step analysis before seizing a retirement account. The first thing they're going to ask is, are there other assets that are available that they could levy instead, that they could just take some other asset to satisfy your tax debt? Then they're going to ask, has the taxpayer's conduct been flagrant? And if your conduct has not been flagrant, then they're not supposed to levy your retirement account. But flagrant conduct is obviously a subjective call, and it can include such relatively innocent behavior as contributing to the retirement account at the same time that you have an outstanding tax debt. So it's pretty easy to be flagrant. And then finally, they have to determine if the account is now or will be in the future necessary to provide for basic living expenses. And you may be thinking, whoo, that's a relief. My account is definitely either necessary now or will be in the future. And you feel safe. They can't take your account because they're definitely going to not be able to pass that third hurdle. But back up a little bit. Remember, the IRS has very different ideas of what your basic living expenses are than you have. And so if you are or will be eligible for Social Security, they may determine that the Social Security payments alone will be sufficient. Again, if you're a single taxpayer with no dependents, they may look at your Social Security and say, well, that's going to be $1,200, and then they'll just seize your entire account. The IRS is not going to levy your retirement account or garnish your retirement payments without a warning. But it may feel like you're just getting a little bit of warning. You're going to receive a letter that says final notice of intent to levy. But it's not going to say we're going to take your 401k. It's just going to basically say we're going to look around and see if we can find anything to take. A lot of people don't realize that includes retirement payments and retirement accounts. Now you know. If the IRS is levying your assets or garnishing your wages, whether it's your bank accounts, retirement accounts, your house, your car, your Social Security check, your paycheck, or any other asset, there are steps that you can take. And note that I have individual videos on each of these programs. So one thing that you can do is you can simply pay off the debt. If you have the money or can get the money, paying the debt in full obviously will stop all levies and garnishments, and the IRS will also lift any liens that they have filed against your property. Another option is to file a collections due process appeal if you're within the appeals window. This is an IRS internal appeals process. It's only going to be available to you relatively early in the process. But they're going to pause any collections activities while your appeal works its way through the IRS process. You can also set up an installment agreement. Once you've established an installment agreement, all collections activities are going to cease. However, any liens that the IRS has filed are going to remain in place until the installment agreement is paid in full, or until you get the lien released some other way. You can ask for currently not collectible status. If you can demonstrate to the IRS that you can't pay your basic living expenses while at the same time making payments on your tax debt, you can be put into currently not collectible status. But be aware that the IRS's ideas of how much you need for your basic living expenses is quite low. For example, the IRS says that if you are a single taxpayer without dependents, you can live on about $1,200 a month. I don't know a lot of people who can live on $1,200 a month. You can also file an offer in compromise. An offer in compromise is a formal offer to the IRS to settle your tax debt for less than the full amount. And while they are considering your offer in compromise application, they're going to stop all collections activities, and the process can take from a few months up to as much as 2 years. Additionally, you can file for bankruptcy. When you file for bankruptcy, an automatic stay stops all creditors from any collections activities, and this includes the IRS. If you have a substantial amount of non-tax debt, this can be a really good option. But not all taxes are dischargeable, and it can be tricky to figure out which ones can be discharged. I have a video on this issue as well. If most or all of your debt is taxes, an offer in compromise is often a better choice. Or you can file for innocent spouse relief if your situation qualifies. If you are or might be an innocent spouse, the IRS is going to cease collections activities while they consider your application. And finally, check to see if you are approaching the 10-year statute of limitations, which is the limit on which a tax is collectible. You might just be able to wait them out. However, it can be a little tricky to determine exactly when the 10-year statute of limitations is up, because there are many situations that are going to toll or suspend the running of the 10-year limit. Disclaimer: this video and any accompanying text is for informational purposes only. The information provided does not and is not intended to constitute legal advice. No attorney-client or similar relationship is formed. If you require legal advice, please contact an attorney or other legal professional. This video covers a complex legal area in just a few minutes, and of necessity leaves out much of the detail. Don't make decisions based only on this video.